Hi, and welcome to this webinar on emerging market equities. My name is Adam Peterson-Ilafi, representing the East Capital sales team. With me, I have Jacob Grapengiesser, our CIO based out of Hong Kong, and Ritish Rangwalla, Senior Independent Analyst based in Mumbai. After the summer, we've seen volatility pick up a little bit in the markets, and we're seeing more and more calls for diversification. Concentration has risen. One of the most obvious ways to diversify is through emerging markets. But in our conversations with investors, we are getting some questions on the outlook for emerging markets, which is why we've invited you all here to share a little bit of our view on what's happening and the outlook going forward. But to start, we have had a very strong start to the year in our global emerging market strategy. And Jacob, I would like to ask you to elaborate a little bit on how the fund is doing this year.
Yeah, thanks, Adam. Unfortunately, my summer vacation was slightly ruined by the market volatility, and we were doing also quite a few trades. Actually, we took some money off the table in the middle of the summer. So ahead of the volatility, so we actually had some cash to deploy during those very volatile days, which was a good thing. If we look on the performance, so I'm actually proud to say that we are the #1 fund in our little peer group with about 50 funds since we launched, and we're also #1 year to date. And that means a 5.4% alpha or outperformance this year. And I think the point is that this has been really driven by many different markets. It's not we made one bet on something. This is just consistent performance in each market. And to make it clear, India is very different to China, again, very different to Brazil, very different to Turkey. So we are adopting slightly different approaches for all of these markets. Maybe just a recap of the fund. So this is a very actively managed fund. Close to half of the names are not even in the benchmark, and we have a close to an 80% active share.
Very impressive performance. Now over to the outlook. We only have 20 minutes. We will be addressing the key topics we're hearing. It's impossible to speak about emerging markets without talking about China. Jacob, you happen to be based there.
Yeah.
What are you seeing happening there?
Yeah, I was back after the summer, only for a week actually. But I managed to speak to the local people and yeah, from my own opinion. Unfortunately, there is no good news from China. I'll be honest about that. We had a third plenum, which is a sort of a party congress on the economy, and there were really nothing that came out of that, I must say. So the target is for China to grow around 5% this year. I would say that we are at 3-4% growth. So we would need to see larger stimulus packages or measures coming out from the government. We are not seeing that yet. It's this kind of constant drip feed of measures. China is all about real estate. Real estate prices are down 8% year on year for the secondary market. Personally, I think that the Chinese real estate market would probably bottom out maybe 18 months from now. Maybe it will take a bit longer, but that would be the key turning point for the Chinese market. China is down 50% over 3 years. So, of course, the market has corrected a lot. I think it's a bit misleading to look at the just index PEs, etc. I think it's, even for me, it's hard to grasp that. What does it actually mean? So what we have been doing is that we have been looking on individual companies, and we've been plotting these kind of charts. This is just the valuation, just a simple P ratio for the past 5 years. How was this company trading 3 years ago, 5 years ago? What is the difference in valuation, and what is the difference in the business? How has the business outlook changed? Of course, for many companies, the business is significantly worse. Let's be honest about that. But if you look on a company like China Education, operating private universities, the business outlook didn't change much. Maybe growth went from 20% per year to 15% per year. I had a long chat with the CEO during the summer. So this company, 5 years ago, it was trading at P 2025. 3 years ago, maybe it was down towards P15. Now it's down to P4. And by the way, the company started to pay out more cash as cash dividends along the way. So it's a 10% dividend yield and P4. So this is how we see China. We don't really look at the economy so much. We look at the companies that in such an economic environment can still do relatively well. I don't think I want to go through all the names here, but these are just 4 names that we have in China. I think this represents, let's say, 1/3 of the exposure we have in China. You can look at the performance numbers, plus 45% year to date, plus 69% year to date, plus 67. I mean, pretty spectacular numbers, right?
Absolutely.
So even if we have this bad news or no good news, at least on the economy, companies are doing quite well. And to keep it short, I would probably say that it's all about, of course, stock picking, right? To find the companies that maybe they were not making money before, they're starting to make money now. Meituan is the largest food delivery platform. They never really made money, but now they're starting to make money and they're broadening their scope of services. Shifu is buying back a lot of shares, so think it's simply a cheap company buying back shares, close to 40% of the free years of the company. That is just technically pushing up the stock, right? It's a 17% yield. But overall, we are relatively conservative investors. So what we want to have is a large portion of we want to buy companies cheap and then a large portion of that profit return to shareholders. So if you look at the numbers here, 17% all-in yield, that means buyback plus dividend, 14%, etc. These are the kind of numbers that we would like to see, because that also protects us in a bad environment, right? If a company is paying out a lot of money, buying back their own shares, it probably will also fall less in a bad environment. And in a good environment, obviously, it will also perform, as we can see from these numbers.
Thank you, David. Or Jacob, sorry. I think people are focusing a little bit too much on the economy. It's super impressive to see companies with 14 to 17% yield growing 30 to 50%. I don't think there's many markets where you can find that, actually. So good to see that the companies are at least performing. The other main market of interest is performing a lot better. It's India. Why has there been so much excitement about India over the last few years?
Yeah, so India is the obvious story in emerging markets. It has high growth, 7-8% per year, but it's also in a good geopolitical spot. Geopolitics is probably an advantage for India because large companies are diversifying away from China. It's not that easy, so they're saying China +1. So they have production in China and one more country, and that one more country is in many cases now India. Apple started iPhone production in India. And it is also the world's largest democracy, which is, I think most investors think that is a positive thing, right? If we look on the high level numbers, so Modi has announced that India should become a developed market by 2047. That's pretty far out, but it means that the economy would go from a current size of $3.9 trillion to $30 trillion.
Massive.
8 times. 8 times growth. Obviously, it's not going to be easy, but if you look on, for example, manufacturing, I met over the summer the CEO of one of the largest industrial groups in India, and he said manufacturing will grow 23 times. And obviously, the big investors in manufacturing, I'm not sure it's going to grow that much, but it's going to grow massively. That's just for sure. I will soon leave the word to my colleague Ritish, but I would just point out one piece of information here. So if you look until 2030, 2047, of course, is pretty far away and a lot of things can happen on the way, right? But if you look until 2030, 500 million people, so more than all of EU, will move into that mid and high income bracket. That's a lot. And that's only in the next 6 years, right? And I think 6 years, our fund has been running for close to 6 years. So basically it's another, lifespan that we've already done. I mean, we can imagine that happening. And this is, of course, where we're targeting our investments. But, how to get to that might not be that easy, Ritish. So I'll leave it to you to explain, please.
Sure. Thanks, Jacob. So, look, we have a pretty aggressive target that's set out by our Prime Minister. Can we get there? It's not going to be a linear path, but we certainly believe that we have the right drivers in place, both structural as well as cyclical, to take the country forward in that direction. Let me just highlight a few of them. Number one, we have continuity of the Modi government. He's been in power for the last 10 years, and he's just won another term of another 5 years. Now, Modi, by far, he's a person who wants radical reforms, wants to reduce the role of the government and increase the private sector participation in the country. And all the reforms that he's announced over the last 10 years and he plans to announce over the next 5 years are going to be in that direction. In terms of the demographic dividend that we know of, that Jacob just highlighted, the average age of the country is 29 years today, right? And a workforce of around 560 million. The middle class is going to grow, as he said, of around by another 500 million in another 5 to 6 years. So the demographic dividend is unparalleled that we have in India compared to the rest of the world. But I think one factor that I want to highlight is in the structural side is the productivity dynamic that's radically changing in India. Number one is this massive digital revolution that the country underwent over the last 10 years. You started with the Uniform ID program, which gave out uniform IDs to almost 1.3 billion people, the entire population. And we had 900 million smartphone users. Now, the government coupled that and gave out no frills bank accounts to almost 500 million poor people. What does that mean? It, number one, reduced leakages in the government system, avoided all the corruption angles that there were. People were able to get money in their hand from the government in terms of subsidies. Just to give you a figure, $93 billion were given out in subsidies directly to these 500 million bank accounts last year. So the productivity dynamic changes because, people are able to save in the banking network. So formalization happens. They're able to get credit from the banking sector. Where a bank is able to evaluate the amount of savings that the individual has, as well as the individual is able to build a credit history. So the wheels start turning from there. Another productivity dynamic is almost 100 million women in rural India were given gas connections. Now, typically a woman was spending around 4 hours a day cooking using cow dung cakes in the country until now. This was not only unhealthy, but took up a lot of time, as I said. When you get gas connections, the cooking time reduces to 45 minutes, and she has not only does her health improve, but she has all the more time to go and help out in the field, and hence the productivity dynamic of the country changes. One of our iconic programs that was revamped over the last 5 years is the fact that Modi started giving out midday meals to 150 million children across the country in rural India. Now, think about it this way. A typical rural household with 4 individuals, 2 adults and 2 children, they eat only 2 meals a day. As soon as the 2 children are just forced to go to school, where literacy rates increase, as well as the wallet share of the household increases because that entire burden of feeding those 2 children goes down. So these are some of the social dynamics that are going to transform into the economic growth of the country. And lastly, on the infrastructure side, we've seen unprecedented infrastructure growth over the last 10 years. In terms of number of airports, we were 74 at 2015. Now we are at around 145, have plans to add another 100 in the next 10 years or so. In terms of the highways added, we've added, I think, 50,000 kilometers of highways just in the last 10 years. So, the country is on the move and has all the right recipes or the right drivers in place to take this growth forward on the long run basis. From the cyclical point of view, I wanted to highlight 2 parts. Look, prior to 2015, India always suffered from the twin deficit problem. That is, the leverage on the balance sheets of both the corporates and the banks was always considered too high to fund growth and front capex of the country. So what has happened since Modi came in and the RBI stepped in, a lot of cleanup has happened, both on the corporate side as well as the banking side. Corporate balance sheets, which were over-levered in 2015 at around 1.2x, through discipline and through increasing profitability, have brought leverage down to almost 0.5x. Similarly, on the banks, they've been through a massive cleanup, and leverage ratios are at an all-time low. And the cost of the credit cost for banks have gone to almost 0.5x. So, yeah. Just wanted to highlight one factor that Jacob mentioned about the middle class. Now, this chart probably explains that when a country moves from a developed or developing to a developed nation, the entire middle class, once they start moving higher and higher up the income front, this leads into a multiplier effect on the overall income of the country. Just to give you a figure, we currently have 60 million people in the country with earning around $10,000 per year. This figure is expected to go to 100 million by the end of fiscal 27. And when this middle class and affluent class start consuming, the sectors that benefit the most are, for example, financial advisory, wealth management, as well as healthcare. And as you can see, India's expenditure on both these fronts is far lower than relatively seen across the world.
Thank you very much for stepping in there, Ritish, to add a little bit more color on the demographic developments and the implications for the economy. It's always interesting to hear from someone who is on the ground and lives and breathes these markets. Can you tell us a little bit more about the market performance and what the implications of that has been for global markets?
Sure. So, Adam, look, the story that I just highlighted is not going unnoticed. Okay, and as can be seen, India has been one of the best performing indices globally over the last 4 years or so. Both the large caps, but the mid caps and the small cap index have far outperformed. Now, this is largely driven by an extremely optimistic domestic investor base, which has a newfound sense of optimism for the country and outlook. Hence, there is a lot of wealth moving into equities, right? And this has not only reduced the volatility of the country, but has also kind of, I would say, to some extent, stretched valuations to some extent. But I would like to highlight that this entire rally that we've seen in the last 4 years, the foreign institutional investors have largely missed out. Historically, they have one of the lowest weightages in the country on India compared to their history. So I think, yeah, there could be a big crowding out effect once the foreign investors lose patience or waiting on the sidelines and finally decide to come in.
Yeah, I mean, the case is super strong, and I think no one can argue that. Are there any particular themes that we like to play India through?
Yeah, sure. So look, I basically came in with around and joined East Capital just around 2 months ago. Quickly, a brief about my background. I've had 15 years of experience in asset management, 5 years on sell side, and last 10 years in the buy side, covering largely mid and small cap stocks. These are the companies that we largely focus on at East Capital also, because these are companies that are largely below the radar of brokers. And this is the edge that I plan to bring in by being on the ground, by having more plant visits, by having more regular and frequent management discussions and management meetings, and also, expanding our coverage universe within the country itself.
Yeah, you've been traveling a lot, visiting all of these companies recently. Are there any particular companies you would like to raise from your recent trip?
Sure. So one of the themes that we really like is recycling in India, and this company that we've invested in, Ganesha Ecosphere, is one of the largest polyester PET bottle recycler in the country today. Recycles around 7.5 billion bottles annually, and now it is moving into food grade PET bottles. So, which is the first of its kind, because it's an extremely technologically intensive process on the R&D side as well as on the manufacturing side. And the reason why we believe Ganesha will largely benefit is there is a government regulation kicking in, which is going to mandate 30% of recycled content in all food grade bottles starting April 2025. So another of our companies where there is no broker coverage. So this is something that, we really appreciate and like. Another company where, as we were talking about financialization and how the amount of wealth that is managed by wealth managers in India is relatively low. We picked Nuvama Wealth, a very young but a very creditable wealth management franchise. So this company works in three divisions. One is capital markets, one is wealth management, and asset management. And on the wealth management side, they over the last 4 years or so, their assets have grown to around $8 billion, a 33% CAGR. On the asset management side, they manage close to $1 billion. And until now, the earnings growth has been extremely impressive. The capital market space has grown profitably around 150%. It's gained market share from other domestic brokers, and it continues to ride on that wave. As you can see, we saw 190% growth in its profitability, and as the build out for the asset management space and the wealth management space comes to an end in the next 2 to 3 quarters, we expect the costs to reduce and the profitability, the ROE of the company to rise manyfold from here.
Super interesting themes. Thanks for sharing some color on them, Ritish. I think it's hard to argue that India will need recycling going forward. What's crazy is that people don't seem to realize that yet, looking at the investor base of these companies. In November, we will be hosting the East Capital Summit in Tallinn, Estonia. We will dig a lot deeper into the outlook there. Invites are being sent out as I speak, so if you haven't received yours already, you will receive it shortly. Thank you very much for listening in. Should you have any further questions or want to know more, reach out to your sales contact and we'll set up a call. Thank you very much.